Hello, everybody. I hope you can hear me. I welcome you to the class. In this short video, we're going to look at the methods of measuring GDP. All right. In the other class, in my previous video, I looked at what is GDP. And in this one today, we're just going to focus on the methods of measuring GDP, which are also called the approaches to measuring GDP. So we have three methods that we can use to measure GDP. So we have the expenditure approach, the income approach, and the value-added approach. In the other video, in the same video, I will expose you to the other names that can be given to, that are given to these approaches. Okay, but to begin with, I'll first expose you to something that will make it easier for you to understand all these concepts. So we're going to first of all look at the types of goods that exist, okay? These are not the only ones, but obviously there are quite a number of them. But to understand what we're about to do, you must first understand these two types of goods. Okay, I'll emphasize on this. All right, so the first one that we have is a final good. So what is the final good? The final good is simply a good that is purchased for the purposes of final consumption. All right, or in other ways, what I can say is the final good is simply one that is purchased by the ultimate. So the word ultimate there is symbolizing the final use of the product. All right, and whereas an intermediate good is one that is used to produce other goods. Okay, most of the times, if you look at other definitions, an intermediate good is more like an ingredient. It is something that you use to produce something. All right. I'll give you an example. If I go right now to ShopRite, let's say I go and buy sugar. All right. If I buy sugar and I'm going probably to eat rice together with the sugar, I'm going to so I'm buying the sugar to go and consume it. So the sugar there will be looked at as a final good. But if, for example, the same Duncan goes to buy sugar, but in this case, I want to, for example, to go and make a cake, okay? The sugar there is being used to make a cake. So you look at the same sugar to be called an intermediate good. All right. So these final goods, intermediate goods are simply goods. But for what purpose are you purchasing them for? If you're purchasing it for consumption, you want to go and consume it, you want to use it, you call that a final good. But if you're purchasing it to go and use it as an ingredient, we call that as an intermediate good. All right. So having said that, now we can come here now and look at what is the expenditure approach. So the expenditure approach, it sums up all the final goods in the economy that have been purchased by the final user. Okay, I should have added something there. All right. So now if you have all the final goods that are in the economy, how many final goods do we have, and who has purchased them? The ultimate user, the final user. So you sum them up. So for example, if you say how many goods have been purchased in the economy for final consumption, let's say we say bread, maybe we have used 10 loaves and stuff. So you sum all of them which have been used up, and then you get to find their total. That is the expenditure approach. Okay, so obviously we'll do a mathematical example so that you can get to see this. All right, but all in all, I just want you to know that expenditure approach sums up all the final goods that have been purchased in the economy. All right, and then who can purchase these goods, you might ask. So the economy is divided into four sectors. All right, we have the private consumers, who is you and me. We also have the business sector, we have the government sector, and we have the foreign sector, which has to do with exports and imports. All right. Now, the money that consumers, you and me, we use on final goods and services. So, for example, I go and purchase Coca-Cola, I drink it right now. That Coca-Cola will be recorded as consumption. The money that I spent on Coca-Cola will be recorded as consumption. So, consumption is simply the money that is being spent by private consumers on goods and services, domestically produced rather, goods and services. All right. Then what about firms? Firms can also go and buy, firms, for example, can buy a laptop and go and use it for businesses or something. So if they are purchasing whatever firms are buying, whether they're buying this or whatever, if it's a final good that they're purchasing, for example, if they buy a laptop, they're buying a laptop for final consumption because they're going to be using the laptop probably for their recordings or whatever. So whatever firms purchase, okay, I don't want you to confuse this with the intermediate good, but I'll talk about that in the example. You'll be able to see it. But when firms spend money on final goods and services, we call that investment. All right. When the government spends money on goods and services, we call that money government expenditure. Then we also have the other sector, which is called the foreign sector, we have exports and imports. What are exports? Export is simply the money, okay, spent by foreigners on domestically produced goods and services. So for example, if Zambia here, we produce phones, and the phones, we get them and sell them to a South African. So that money that the South African spends on the Zambian produced good will be called an export because it's been produced in Zambia, right? Then an import, obviously, if you're importing, it means you're buying something from outside the country. So imports is simply money spent by citizens on money spent by citizens of a country on foreign produced goods and services. All right. So therefore, the expenditure approach will simply add up the consumption, the investment, the G, the government expenditure, exports minus the imports. The reason we are subtracting imports, if you look at the definition of GDP, GDP, we're looking at what has been produced within a country. So it means if the good has not been produced within the country, those are recorded as imports. We need to subtract them from GDP. All right. So we have the consumption, the investment, the government expenditure, and the X. All right. I hope that is very much okay. I'll go straight ahead and explain what is the income approach. So if you look at the income approach from the word income, okay, so it's income, it's adding up all the incomes. If you look at the other one, it is called the expenditure. So it's adding up all the expenses that were done. Income, you look at the money that is coming in. So the income approach sums up all the income that has been earned from the four factors of production in an economy. What are the factors of production? Factors of production were four factors of production: land, labor, capital, and enterprise, okay, or entrepreneurship. All right, these are the four factors of production. Okay, if you did the introductory class, you know, I don't just like to go into details on these, but if, for example, you sell labor, okay, or you go and work, if you go and work, at the end of the month, they give you money, okay, called salary, or they're called wages. All right. And then we have from land, what's the money you earn from land? We call it rent. And then from capital, we earn interest. Entrepreneurship, when you do a business, the money that you earn is called profits. Okay. So all the monies that are coming from the factors of production, we sum them up, we form what is called the income approach. So if I add up all the salaries in the economy or the wages, I add up the rent, the interest, and the profits, that forms what is called the income approach. Okay, should be very straightforward. I'll move on to the last one, then we'll do an examination question that looks at all these things so that you can have a more clear picture. We look at the value added. The value added is simply like a profit, okay? I want you to look at it in terms of profit. It sums up all the value that has been added to a product at each stage of production. I'll give you an example. If right now there are people that do this, I think at Katondo, you know, streets, they buy a phone from you, which is damaged. They go and fix it. Let's say, for example, they buy a phone from you. Maybe you see the screen is not okay or something. Then you just sell it to them maybe at 1,000. You would have bought that phone probably brand new, maybe at 5,000. So they buy it from you at 1,000. It's spoiled. It's not okay. But what they do is that they go and fix it. What they're doing there by fixing it, and they fix it, it's now okay, and they go and sell it. Let's say you sold them at 1,000, they sell it at 2,500, meaning they have made like a 1,500 value. Okay, so now what you're going to look at, the value that has been added to that phone, which was not there when you were selling it. You were selling it at 1,000. For them now to come and sell it at 2,500, that means we have the 1,500 as value that has been added to the product that was not there initially. Okay, so that is the value that has been added. So you look at each stage of production, what is the value that is being added? All right, so there is a general formula. You get to see this when you do the example. So the value added is simply equal to, that E there should stand for summation. I was just looking for the summation symbol when I was making up my PowerPoint, but I couldn't find it. But that's the summation. Okay, it should be summation. Don't take it as E. So summation of the gross value, which just means sales, whatever sales have been done, subtracting the intermediate goods. All right, so now I need you to get a pen. Okay, if you're watching this video, recorded video, please pause the video, get a pen, get a paper. I want now us to do the practical thing of this. Okay, so go straight to an example. All right, I hope you now have a pen and a paper. Let me just give you a minute to do that. All right, I hope now you have a pen and a paper. probably under calculator as well, but the numbers we're dealing with are not strange numbers, all right? But I'll be adding here as well with my calculator. So I hope that we can do this together, all right? So let's look at the first one here. So we have a question here. This should be an from Unza, one of the past papers, one of the most recent. I think this should be 20, not zero, 2020, I think 2020, 2023 probably, all right? So we can look at this question here. And the question says, well, dealing with the question 2, it says, suppose you have an economy that consists of two firms. We have the chicken farm that produces live chickens, and Hungry Lion, a fast food restaurant. Using the information provided in the table below, clearly showing all your calculations, solve the following. All right. So we have Hungry Lion, it's a restaurant. And then we have this chicken farm that is producing the live chickens. So we've been given this table here, okay? And then we're being asked to calculate GDP using the different approaches, all right? So let me just bring this here. And then let me just move this here, all right? I hope we can clearly see the everything that is here. All right, so let me just take this up as well. All right, so we have the chicken poultry farm. Okay, these are the sales, the revenues, the expenses, everything that the chicken farm is doing. These are their records that are here on the left. And then on the right, Hungry Lion, a fast food restaurant. So this is the business. Obviously, you know what Hungry Lion does, right? Yeah, they sell chickens to you and stuff. So now they're saying calculate GDP using the final goods approach. The final goods approach is the other name for the expenditure approach. Remember, the expenditure approach sums up all the final goods purchased in the economy. So the first thing you're going to look at is to look for all final goods that have been purchased. All right. And that is simply going to be how easy it is. Remember, we said the expenditure approach, which is also called the final goods approach, sums up all the goods, okay, that were purchased by the ultimate user. Now, the ultimate user is the final user of the product. So when we are calling it a final good, it means the person who purchased it is the ultimate user, the final user of the product. So now here we have, for example, let's start with the poultry farm. So you have revenues out of the chickens. So this poultry farm, we are saying we have sales to households. Now, households are simply talking about people, you and me. You know, we buy things, we take home. You don't take home to go and make chickens. That's a business now, okay? But when a household purchases goods and services, their aim is to obviously go and eat the food. So we don't purchase chickens to go and sell them again. That's now becomes a business. But when we're talking about households here, we are assuming what we know is that households, they're not businesses. They buy to eat. So we have sales to households. So the question is, are households final users of the chickens? Yes, they are. Okay. So we have households, then we have got also sales to foreigners. Okay, now we have not been told anything about these foreigners to be business people. So if they have not told you about anything, for example, Hungry Lion here, they've told us Hungry Lion is a fast food restaurant. So you know Hungry Lion is the business. They're buying these chickens and they're going to sell them to people. So Hungry Lion will be considered as a business. But here, you look at the households, nothing has been told, so we consider them as final users. The same thing is happening to foreigners. Nothing has been said about foreigners, so you consider them as final users of the product. Then Hungry Lion, we know it's a business, right? So what other sales were made here? We're also being told about house to house sales. I'm sorry about that. My internet just cut. Okay, so we resume. Now, I'm saying, if you look at this, we begin to add up. Okay, so let's look at all the sales that were done in this economy. All right, so the first one that we have is the sales to households. So you can write 10,000 there. Okay, so 10,000. Then we also have sales to foreigners. All right, so we have another 10,000 here that we add. Then what about the sales to Hungry Lion? Sales to Hungry Lion, remember, Hungry Lion is not the final user of the product. They'll get the chicken and they'll go and sell it again. So we don't get to add them. So you leave this 10,000, which was sold to Hungry Lion. Then you go and look at these. These are wages. We don't add them under the expenditure approach. Profits, we don't add them. We look at the other ones here. We have revenues under the Hungry Lion. So let's go to the Hungry Lion. Sales to households. So these are sales. We can add the 50,000 there. So save plus 50,000. What's remaining? These are expenses. So we have wages, chicken profits and stuff. So we don't get to add this. So we are only interested in the sales that were done by the ultimate users. So if you add up all these that we have added, the 210s and the 150, we are finding 70,000. All right. So that 70,000 is all that is done on the final goods approach. All right. Who bought the final goods? All right. In other ways, who bought the chickens here for direct consumption? So that's the first one that we have. So under the final goods approach, we have the 70,000. I hope that is very much okay. So remember, I'll just repeat for the last time, when you're looking at the final goods approach, what you focus on are the sales that were done in the economy. And these sales must be done. They must have been purchased. Okay, whatever product or goods should be purchased by the final user of the product. So in other ways, who's purchasing it to consume it or to use it directly? So we have households, we have foreigners. Hungry Lion, we don't add. We just add up these, and then also whatever sales were done by households and foreigners. For this case, that's all we have. Okay, so that's all under the expenditure approach. We go to the next one. We conclude. We have the value-added approach. But before we go to the value-added approach, let's answer first of all this one because it's short. The GDP using the factor payment approach. So factor payment approach is just the other name for the income approach. Okay, I hope that is clear. So here under the income approach or the factor payment approach, you get to focus on the incomes that were received in the economy. So in other words, we're looking for those four factors of production. Remember, we have the wages, the rent, the interest, the profits. Those are the things that you're going to look for in this table. So let's start with the chicken poultry farm here. So the first part, obviously, we neglect it for the revenues. We have sales to foreigners and stuff. So we come here, we have wages. So we're going to add up the wages, right? Plus profits, we'll add them, obviously. They're an income, right? That's all I think on the poultry farm. Let's go to the other one, a Hungry Lion. We have the sales. We're not interested. We're interested in the wages. So add up the 15,000 there. And then we have the profits that are here, right? So these are the profits that they made. They made 25,000. All right. Chickens, this chicken is what they bought from the poultry farm. So it's an expense for them. So we don't get to add it. Okay. So we just have this. So when you add up those 10,000, 20,000, 15,000, and 25,000, you must get a 70,000. Those are the only incomes that were there. All right. And that's all about the income approach. All right. I hope that is okay. All right. Let's move on to the last one now. All right. I hope you're finding this simple and straightforward. Let's go to the last one now. Now, the last one is the value-added approach. Under the value-added approach, please, guys, I want you to pay attention. The value-added approach is very close to the final goods approach, which is the expenditure approach. Okay. Now, remember, under the final goods approach, which I explained at first, I said, look for all the sales that were made, okay, done, which were sold, everything that has been sold to the final user, okay? So meaning you go for the sales and check, oh, is this guy that bought this, is a final user or whatever? And then you check, oh no, this is a business, so we don't add it and stuff. But for the value-added approach, you just get, so long as it's a sale that was done, get it. So any sale that was done, just get it, then subtract the intermediate good. All right, that was used by the producer of that product. Let's start with the first one here. We have the chicken poultry farm. Let's start with the chicken poultry farm. The chicken poultry farm made sales to households, right? 10,000. So we have that 10,000. So we get it. From the 10,000, subtract the intermediate good. The thing is, what is being sold here? It's chickens. The question is, what are the things that this poultry farm used to produce these chickens? Now, normal circumstance, obviously, you know, to say to grow chickens, probably you need to spend some money on the chicks themselves. Probably you buy them from somewhere and all that. But here we're not being told where this man, the chicken poultry farm, what they are using to produce the chickens. So if we're not being told anything, it means their cost is a zero. So you just say 10,000 minus zero, because we're not being told. But if the question had probably told us the chicken poultry farm buys chicks at maybe they say 5,000, would have said this sale, the whatever they sold, the chickens will be subtracting the 5,000. At each time they sell chickens, will be subtracting 5,000. But in this case, we have not been told anything. All right. So we leave it as 10,000. So you say 10,000 minus zero. Then we'll say plus. What sale was also made? It's sales to foreigners. The same thing. Who sold? Is the chicken poultry farm. Where did this chicken poultry farm get these chickens from? We don't know. So it's just a minus zero. So I'm just going to say 10,000 again, minus zero. Okay. Sales to Hungry Lion. Who's the seller? So always focus on the seller. So we have this 10,000. So say plus 10,000 minus. So the seller again is the poultry farm. So if the seller is the poultry farm, we're being told here they don't have any cost. So you just consider it as a zero. Okay. So it will be just 10,000 minus zero. So we are done with the sales that were done by the chicken poultry farm. Let us go to the last one, the sales that were done by the Hungry Lion business. So Hungry Lion made only sales to households. And how much was it? 50,000. So we're going to say plus 50,000. So we say 50,000. So I've been adding. So we add we have 3 tens, right? Which have made 30,000. Then now we go to the revenues. We have this 50,000 here for Hungry Lion. So now we'll say 50,000 minus. The question is, what is Hungry Lion selling? They are selling fried chickens. Where did they get the chickens rather, just not fried chickens, but they're the ones who fried it. But obviously, we're not looking at the fried chicken. We're just looking at the chickens. So where did they get the chickens? They got the chickens. You can even see on the expenses there, it's there. They bought these chickens from the chicken poultry farm. At how much? They bought it at 10,000. So we're going to say this 50,000, you subtract the 10,000. Okay, meaning the value they added to the chicken is 14,000. So when they bought it initially, it was just worth 10,000. But after frying it, adding the spices, that's value added to the chicken. You can also go and buy your own chicken at 10,000 and eat it in the house. But why are you going to Hungry Lion and buy it at an expensive price? Is because Hungry Lion is getting the same chicken and they're adding value to it. And in this case, they bought the chicken worth 10,000. They're going to sell it at 50,000, meaning they have added a 40,000, which they're claiming as the value that has been added to them. That's the niceness you feel, the spicing, all the things you like about Hungry Lion chicken. So they add value to it. And in this case, it's the 40,000. So if you sum everything up and if you sum the 10,000, these 10,000s, obviously, if you sum these 10 plus 10 plus 10 minus zeros, it will remain just 30,000. And then you go to the sales to Hungry Lion, you add this 50 and subtract the 10, you'll find is 70. And here's my conclusion. All the methods for measuring GDP should give you the same answer. It doesn't matter if you look at quadratic equations in mathematics, I think, we would use different methods, but we all get to the same destination. So the final goods approach, the value-added approach, whatever method you use for GDP, they should all give you the same answer. All right. One of the most common questions, just before I conclude, is that this value-added approach, okay, they tend to use it as well just to avoid the aspects of the double counting. All right. It's one of the things that you get to see. Anyways, I talked about it, I think, in my other class. But yeah, I want you just to have a search on which approach ensures that there is no double counting. The aspect of counting things twice, probably you count it once and then you count it again. For example, I can tell you about when I'm baking a cake. You can count eggs 2 times. You count them one when I'm just buying them, and you count them again when after I've made the cake. So that's an aspect of like the double counting. So I'd love you to search which approach ensures that there's no double counting. All right, that is all about this class. Thank you so much for watching. I hope this was very much clear. I recorded this when I was alone, so there was nobody to ask me questions, but I pray and hope that you guys have understood everything. All right, so thank you so much for watching. My name is Duncan, and I'll get to see you in the other video. Okay, always remember you're blessed, and God continue to bless you. All right, take care. See you.